Hello, good morning, everyone. I'm here to talk about how do you build or how you should consider building a quantitative trading strategy. I'm not into AI as the previous interlocutor, so at least we won't overlap and we won't contradict each other. I'm a little bit more old-fashioned in my way I've built my trading system. And to give you a little bit of background, I'm going to talk slightly about what I'm doing currently, and then we'll dive into the subject. I'm currently the CEO of several startups that we've launched since 18 months, 3 of them to be more precise. We've launched 3 startups, all built around quantitative trading, so there's a purpose why I'm here today. First one is called Napoleon Capital, which is basically a financial advisor, and we currently have some clients already. We're working with an asset manager, which is BNP Paribas, and basically we are advising some strategies, and they're hosting the funds. There's a second structure, which is Napoleon Crypto, for which we've just done an ICO earlier this year. For those who don't know ICO, I'm going to talk about the crypto subject just after this presentation, so you might learn a little bit more about what's behind. But basically, the idea is to provide quantitative strategies for people who are willing to hold cryptos. So we are building a systematic product using crypto as, let's say, the currency of a collection for the assets. And the last structure, which is a Napoleon Index, which is basically our marketing factory for the 2 first entity that we have presented here, that we have just set up, that should be regulated as well. So the 2 first company will be regulated. The first one is already regulated as a financial advisor in France. Second one, we've just applied for the asset management license with the AMF, which is the French regulator. And the third one is also a regulated activity. We have not applied yet, but we intend to apply for regulation here. The idea here is to provide, let's say, a true index publisher like S&P or FTSE, who are also index publisher before being the index that you may all know about. And why have we set up this? It's because we have a lot of quantitative strategies, so we have not developed only one, but we have really developed a series of them. And basically, that's a way for us to demonstrate what we can do with that. It's also some new raw material for people who would be willing to develop new strategies based on the strategies that we have developed. So for us, it will be really our research laboratory, this Napoleon Index, and basically that's where you will see most of the intellectual property ended up with. What was the rationale behind creating 3 startups? Because usually when you create a startup, you don't create 3 of them more or less at the same time. It was very simple. At the very beginning, there was this capacity to generate performance, and I've developed trading models for more than 10 years. I've traded them both at my previous jobs and also from a personal point of view. So basically, that was really the beginning. But then when you have this capacity to generate performance, that may not be enough to launch a business. And basically, what we've done is we've launched a business around that. So basically, we looked at various ways to monetize this capacity to generate returns. And that's why we ended up with this 3 structure. The first one is basically dedicated to traditional currency holder, i.e. everyone holding euro, dollars, or sterling, for example, may want to get some return on this money. We didn't want to be the asset manager ourselves because it's a lot of hassle, and we thought that it would be preferable to have a big institution like BNP Paribas as being the one holding the assets. So that's really a strategic partnership for us. And by the way, they should enter into our shareholding very soon. We've been negotiating with them for more than a year, and they should enter into our capital within the next few weeks. For the other one, Napoleon Crypto, it was a different approach because as of today, you have absolutely no asset management company that are willing to propose crypto products. So basically, we decided that we should ourselves become an asset manager that will be proposing crypto product. Once again, this crypto product will be governed or managed using quantitative strategies, and more or less the same one that you have in Napoleon Capital, apart from a few dedicated strategies that are dedicated for crypto. So we have designed also in the last few months some specific trading strategies for crypto. And Napoleon Index, we don't really know what we are going to do with that. Clearly, that's a marketing tool for us, but we may look at ways to monetize this as well. For example, we could sell the trading signals that are included in these strategies, or we could sell, I would say, index or swaps with some counterparty that are willing to buy these strategies. I'm not going to spend too much time on this because that's not really the topic of today. But basically, that was just to outline some, let's say, some ideas and some strategic thinking we had when we developed first this company, so Napoleon Capital. Once again, the real beginning is this capacity to generate performance. The way we intend to do that is that first, we are coming up with a long-term experience in developing strategies, and we have, at the moment, more than 30 strategies running. So we have, I would say, a big book of strategies, and of course, when you combine them, you get something, or you can construct other strategies. But we also intend to open up to external providers, strategy provider. So if you think about Quantopian or eToro, clearly these are places where you can put your strategies and hope to be selected and earn some fees. With us, we have a slightly different approach to what they are proposing. First, we don't believe in mass market strategy provider because, as the previous speaker was saying, you have very few people that are really experienced and skilled to do that. And basically, we are only interested in those people. So there will be a selection process, of course. We also wanted to be, let's say, credible vis-à-vis these guys that we were going to ask to join us on this adventure. And the best way to demonstrate that is to come up with something that is working and that can be sold. And we have already sold some product based on what we've developed. So that's the two mandates that I'm talking about here. Yes, the reason also why we wanted to specialize on quantitative trading, maybe that's the reason you're all here today, and I'm going to talk about this later. But basically, this is one of the only or the small area of growth in the asset management company, in the asset management business. If you look at over the last 10 years, basically, there have been a tremendous growth in this particular market of the asset management. Basically, discretionary trading is less successful these days, and for obvious reasons. If you buy an ETF just on certain index, you get, I would say, a very decent return just because the index is not really moving because of central bank intervention. And I think it's more difficult for people doing stock picking and all this kind of stuff to really thrive into this environment. And this was clearly the case in the 2008 crisis, where you saw basically a lot of guys just ending up showing that they had a big beta on the market. And when the market dived, they dived even more. And then that's how we do it. We don't really care about this. On the crypto, basically, that's more or less the same thing. So we've done an ICO, which is basically a fundraising in crypto, so which was a very fun experience to do. It took us something like 6 months to raise some money, and we did it, and we ended up doing it in late February. Here, the idea is really to create something that does not exist, which is an asset manager that will specialize on crypto. Having said that, of course, from a regulatory point of view, it raises a lot of questions. The first one is, can you hold cryptos as assets in your portfolio? So there have been some answers, at least in France, where you can do that. Of course, provided that you take care of custody issues. And that's not a small issue because most of the custodian banks, as of today, are not willing to take this risk. And then the second part, when you run a fund, is whether you can accept crypto as the currency for your fund. For the moment, this is not a closed subject, so we're going to have a lot of legal work to do on this point. But if we do believe, and that's our case, that the crypto are a potential, I would say, growth engine for the future, I think we should dedicate some time to do that. And we took the bet that it would have to be a regulated business as opposed to an unregulated business, because for the moment, a lot of people are raising funds in the crypto market, and they are just proclaiming themselves as specialists to run this kind of funds. Most of these funds that are raised are not necessarily regulated. They're quite small funds. And we do believe that in the end, managing other third parties' money is a regulated business, and that's why we wanted to apply for this license. So why quantitative finance, and why did we specialize in that? And maybe that's the case for you. The first one is the obvious one, is to remove human emotions. And we all know, if you have traded on a discretionary basis yourself, that human emotions are usually not very good, I would say, indicator or advisor for taking decisions. I think it's just human that you take the wrong decision at the wrong time. So that's a graph that you may have seen thousands of times. And the second element, which I think is more important, and the previous speaker basically touched more or less about this subject, is that we're living in a world where you have more and more data. What do you do with data? Basically, data is information. Information should basically be used in your trading. But how do you analyze data? And that's a very open question. You have very, very different ways to use this data, and we are going to touch on the following presentation. What kind of data should you consider, and what should you do about it? And basically, that opens up a lot of area of research, and I don't think any one of us can research in all this direction. So using an AI engine could be one solution. Because clearly you feed this engine with all the information that you may have with you, and you cross finger and say, well, hopefully something good will come out of this. That's not the approach that we have taken, but that's a completely valid approach, and maybe it will be working much better than what we are doing. We have taken another, it's funny, but in the end, what really matters is that whether does it work or not. And the good thing is that there is no one solution. You can make money in various ways. And I think that's what's interesting in this field. Basically, that's an area where you have a lot of research. You have to work a lot. Sometimes, even if you have worked a lot, implementation is difficult. That's what he was telling before. He had 100 lines of codes, but several thousand lines to implement what he had found. So we're living in a world, I would say, full of data, and especially since the last 10 years or so, we have seen the explosion of social media, because I'm sure that you have heard about people trading on sentiments. But these sentiments are basically based on text or a word or this kind of thing. And since the last 10 years, with, let's say, for example, Twitter, you have had the explosion of available data to trade. I will just mention one drawback, especially if you were to trade, let's say, US stocks. Over the last 10 years, basically, you've only experienced a bull market in this over this period. So I'm pretty sure that whatever the system you would build based on Twitter analysis, your, I would say, average position should be long most of the time, regardless of what you find. So there are drawbacks to this usage of data, and that's something that you have to be aware of, because even if in the end you find something that is working or that has been working in the past, there may be some limitations that you might not be aware of or that you may not have, I would say, touched upon. This is our belief at, I would say, the Napoleon Group. On the left-hand side, basically, you have the traditional asset class. And most of the asset manager or the pension fund manager, they are using these asset classes to build their portfolio, which is fine, and they've been doing this for ages. But I think it's less clever than what they could do. Because if you have a factory that transforms these traditional assets, whatever the way you transform them, but if you transform them, let's say, into strategies or new assets that have characteristics that are closer to what your mandate is, and for these guys, especially insurance company, their mandate is to provide some kind of stable return for their clients. But starting from assets that over a long-term period are not always going up, it might be a difficult job, especially when you're entering into a difficult market, which we have not found for some time, so good for them. But we never know what the future will be. And so we believe that if we transform these traditional assets into, I would say, new assets, and then the transformation, you have plenty of solutions. So we'll try to discuss this later. But basically, you can end up having something which is much easier for you to build a portfolio that will address your client's issue or your client's requirement. We've indicated several boxes. Here, basically, you can have different approaches. One is getting absolute return strategies, because basically people just want to earn money. Another one might be to overperform a certain index, because your client may still be paid to allocate capital to certain asset class, but if you can provide an extra return on this, he will be happy. And the last one is basically an absolute return with some kind of guarantee for more, I would say, capital treatment. And I've managed some, well, because, yeah, I don't present myself, but basically in the past I've managed funds that had some kind of guarantee, so CPPI stuff. And for some clients, it's important to have some, let's say, a floor on their product. So it's more about managing structured product. So personally, I've worked 15 years with, a little more than 15 years with BNP Paribas, mostly in front office, I would say, position, credit for half of my career, and then asset management for the second half of my career, managing structured product based on discretionary approach. That's why I've developed quantitative trading models, because I knew it was very difficult to manage, let's say, assets in various or in difficult market conditions. Just for the record, in 2008, I earned some money on some of my products that were guaranteed and that were indexed on the S&P 500. But I knew that it was difficult. I knew that I had been lucky, and that's why I developed tools to help me take decisions in my day-to-day trading. So now, let's dive into this presentation. So what, or how should you approach a quantitative, let's say, trading model? First, I think, as in anything you do in life, you need to make some observation and come up with a theory. Otherwise, you're looking for something without knowing exactly what you are looking for. So having some kind of, let's say, market observation is very important because you need to observe how the market behaves before trying to model it. And that's a different approach to the previous presentation, which basically gives this to the AI engine. I have developed something which is very different, which is I want to understand what I'm doing. I started from this more than 10 years ago, and 10 years ago, basically, AI engine didn't really exist. I'm not going to say that I've mastered this, because I think you have to be humble vis-à-vis the market. Even though you may have found something that have worked for the last 20 years, maybe it won't work tomorrow. But at least you need to understand why it has been working, what are the drawbacks, and why should you be looking at to see whether what you have developed is still working. And that, for me, is very important. So once you've observed the market, you need to try to imagine what's the behavior, I would say, the behavioral behind this. And most of the time, you're trying to observe what's the behavior of human. Of course, these days, you have more and more algos, you have more and more, let's say, actors in the market that are less driven by their human nature and more by a systematic approach, but still they are behind, even behind let's say, the models, they are human people. So I think, for me, it's important to try to understand what's behind basically what you're developing. I'm not saying that it's easy to do, because you have very, very few ways to make sure that it's the case. In the end, what's really important is that your system is working. But I think you should try to put some words behind or on what you have found. First, it's a very good exercise when you're trying to market your solutions, because most of the time people marketing their, let's say, their findings are just marketing performance, which is good. In the end, clients are buying performance. But then, when they have to go to an investment committee, it might not be enough. They might need to try to understand what's behind. Of course, you don't want to reveal the secret recipe, and I'm not going to reveal any secret recipe today. But at least they need to be able to say a few words behind what's the strategy that they would be buying into. That's why it's important to try to verbalize this. And it's a very good exercise also to try to understand whether what you have found makes some sense or not. Because in the end, it's not only about data. It's not only about finding something that has worked in the past. It's about making something that makes sense from a financial point of view. And my background is a credit background. I'm quite grounded as a human, I would say, person. That's why I need to, before being comfortable to trade something that I have found, to try to understand whether it makes sense or not from a financial point of view. Second element, of course, once you've done your market observation, you've tried to put some kind of theory behind that. You need to define a rule book, because in the end, that's what you will be selling or you will be implementing on a day-to-day basis. So rule book is that if, let's say, for example, I'm going to say, of course, I'm going to mention a very somber example. Let's say that your trading model is that if the price is above the 100 days moving average, then you have to buy the market. If it is less than 100 day moving average, then you do nothing, which is a very, very basic model. We all agree on that. Basically, that's your rule book. And in the end, you have to define this rule book. At least that's our approach. You have other approach, which is I prefer to have a black box there that will do the work for me, and hopefully it will do just fine, hopefully. Once again, as I explained before, I prefer to know what I'm going to do. For example, rule books, if you have UCIT strategies, you may find the rule books because that's compulsory for them to publish them. So if you go on the internet, some of the investment banks are promoting UCIT strategies, and for that they need to disclose the rule books. So if you're interested, you can have a look around on the internet. You have some strategies that exist, so that's sometimes a start if you want to do some research, because instead of starting from nowhere, at least you have something to start from. And then, of course, once you've defined the rule book, what you can do is you can do some backtesting. And in the quantitative space, that's very important. Usually what you sell is a backtest plus a period over which you can observe what the real life would be for your strategy. As in, let's say, in any statistical approach, you need, let's say, a training model and then a test data set. So nothing groundbreaking. two of the strategies that I'm pretty fond of, but you have a lot of others that exist. So trend following and mean reversal strategies. These are very, very old-fashioned strategies. So you may say, well, it has been researched and everything has been found already. Yes, maybe, but there are still, I would say, strategies that are working. And in the end, what really matters is that it's working or it's not working. So basically, trend following strategies, for me, that's the way I represent the market, is that you have a lot of autocorrelation in the market. You can look at a lot of time series in this market, just calculate the autocorrelation, which is the first approach that you can do, and you can see that the autocorrelation is really, really high. And that's why, fundamentally, trend following models are working. Then, of course, it's a question of what's the time horizon over which it's working. And then you have to do a little bit of research and find, let's say, the right time period to optimize your approach. The second one is the mean reversal strategies. And this one, why are they working? More or less because of volatility. So it's something that is a little bit different in nature. So basically, markets don't go up in straight lines or don't go down in straight lines. In fact, just by the way, in bear markets, so when markets are going down, that's where you see the, I would say, highest rally in the market, which is a little counterintuitive, but that's really the case. So having a model which is a mean reversal in downtrending market is very, very interesting from a return point of view. And the last point is that there is not only one way to make money in this market. Some people are more playing with a carry, for example. So that's another way to earn money on a systematic basis. And there are plenty of other ways to earn money. Our philosophy at Napoleon, at least that's what we've developed so far, we believe that the market are not completely random, even though they look like they're random, but at least they repeat sufficiently enough so that you can find some patterns. And when I'm saying patterns, I'm less talking about, let's say, technical analysis, as you may have all heard about. Maybe that's something that you should also try to model, but for me, it's more an art than a science, technical analysis. But still, I'm looking at it on a personal basis. But markets are less random than it looks like. And that's why, fundamentally, you should find, or you should be able to find strategies that will give you some return over a certain period. So that is the first point. To me, markets are fundamentally unstable, or they're stable but by phase. And it's amazing if you look at just the volatility, which I think is a good indicator, at least for the equity market. You can see periods where markets are going up, where volatility has, let's say, a downward trend. And then at some point, you don't know why. There's something strange that is happening. And then you have a peak in volatility and then a big drawdown in equities. And this is where let's say, the instability comes from. So that's also a representation I have in my mind when I'm thinking about financial markets. These are not stable markets. And I think that's why also it's interesting to have this mean reversal model, because basically I think you benefit a little bit from that. Also, what you need is that if you design quantitative strategies, it needs to be adaptive to this market. Because as I was saying, the markets are not stable. So if you have something that is based or that is rule-based, you have to be careful that whatever the rules you have designed, it needs to adapt to what the market will do in the future. For example, let's say that you've designed, and that's the way I do design my models, the way I do things, for example, on mean reversal strategies. I know that above a certain level, I need to sell, and below a certain level, I need to buy. That's basic. How do I know when the market has gone up enough or down enough in order to intervene? It could be, let's say that the S&P, if I'm taking the S&P as an example, if the S&P rise for more than, I don't know, 5% over a 3 days period, then I need to sell. Very basic stuff. That's not the way I would do things. In fact, what I would do is that I need some kind of measure to say whether the market has gone up or down enough, and then it needs to correct. And this up or down, for me, at least in my development, I use volatility as a measure to check whether the market has gone up a lot or whether the market has gone down a lot. And using volatility as, let's say, a movement measure allows you basically to have a system that is adapting to what the market is doing and how the market is behaving. That's why that's what I'm saying here when I'm saying that your models needs to be auto-adaptative. Second, what you can have is that we all know that usually when trend following models are working, mean reversal model might be struggling. So you may end up, and we all know that markets are, I would say, a succession of trend following period and mean reversal period. The way I develop model, for example, what I do like to do is to alternate this period. So I'm basically putting together a trend following model and a mean reversal model. And then, of course, you need to have a trigger which tells you when to be in a certain mode or in another mode. How do you find this trigger? You have to do a lot of research, but there are easy, I would say, easy ideas that you can test. Volatility could be one of them, but it's not the only one. There are other ways to look at this. So what I do like to do is to develop models that can benefit from one, I would say, a behavior or another behavior, and it basically switches from one to another, which basically allows you to be always, or to I would say, have more position, not necessarily adding the position, because, for example, at some point, you may have two models that have the same position, so you don't necessarily need to leverage your position. So you take only one side of it. But at least it allows you to adapt more quickly to one market or to another market. And I think that's a very interesting feature. Markets are fundamentally moving, I would say, animals, and you need to move as fast as them, or try to move as fast as them. So the market data, or the data that you should use in the system. Yes?
So what is the characteristic time under which one of the assumptions is like mean reversion, trend following? How much to switch over?
I'm going to say just one word on this one. So basically, if you observe the market, trend following models are working over a long-term period. Mean reversal models are working over a short-term period. So the way you have to, let's say, design your quantitative strategies is that you will not have the same time horizon for calculating your position if you look at trend following models or mean reversal models. So that's the first thing. And this is just based purely on observation of time series. That's the way it works. Hold on a second, I'm just finishing. So that's the first thing. Then how do you switch from one to another? First is depending on your time horizon. I have developed models, for example, that are on a monthly basis. I have 2 trades per month, so I'm quite a lazy trader. I don't want to spend all my day looking at the markets, even though I do it, but I don't want to trade every day necessarily. And basically, the switch is sometimes during the month. So I have a time window. So you can have 2 approaches on the market. You can have a price approach, or you can have a time approach, and you can mix both of them. Okay, so basically you have several dimensions when you're looking at the market. It's not only a question of price, it's also a question of time. So that's the first thing. Second, I have also developed daily models where basically I have one trend following model and one mean reversal model, and basically they can complement each other, and they can produce a trade every day. Okay, so it's really depending on the time horizon you want to define. You have to try a lot of them. There is not one single solution. And for example, I may have developed trend following models on a monthly basis that have completely different characteristics than on a weekly basis or than on a daily basis. And for me, what is interesting in the end is mixing them to try basically to minimize volatility and to reduce drawdowns, so to combine them. So as long as each individual models do make some sense on a standalone basis and have, let's say, a characteristic like, I don't know, Sharpe ratio or a return over drawdown that are sufficiently interesting enough, then if you combine these strategies in a certain number of ways, then you will have something that is much, much more robust in the end, just because of diversification. But usually, people think of diversification when they say, well, I'm going to put some bonds, some equities, and over the last X year, it has done quite well, so I'm going to do that. That was, I would say, the traditional approach, and I think it does make some sense. Everyone has to recognize that. But instead of doing this with traditional assets, I'd rather do this with strategies. Yes, you had one question?
You actually answered it, which is about combining different models together to increase the Sharpe ratio.
Yeah, I think that's an obvious thing, and I'm just saying something groundbreaking here. I think diversification is very interesting. You just need to make sure that your models are sufficiently uncorrelated with one another. Otherwise, it doesn't really make sense to have something which is highly correlated to something you already have. It doesn't really add anything to the You can try both, in fact, and I've tried both. And usually, it doesn't really lead to something that much different. Of course, the end result is different because you don't measure exactly the same thing. Even when you talk about historical volatility, should you use, I would say, normal volatility, exponential volatility? I think you have to try a lot of things over different periods. Should you use 1 year volatility, 20 days volatility, 10 days volatility? The way I like to measure volatility myself is look at dispersion, so taking into account the lows and the highs of the day, because this is something that is also very important. It gives you some information. And this is sorry, yes, to define the volatility, I also look at this data, because I think they're very important.
But the implicit isn't.
No, the implicit. The implicit is but the implicit you don't have that much, I would say, indices for which you're getting it very easily. So of course you have the S&P, you have the Euro stocks, but you don't have that much assets over which you get the implicit volatility, unless you're a very good option trader, in which case you can find it. Otherwise, it's not an information that is readily available for a lot of people. So that's why I think it's easier to look at historical volatility, because this one, everyone can calculate it, and you can calculate it on all the assets that you may think of. So in terms of data that you might consider to develop trading models, and this is really where the field is opening up a lot, because not everybody will have the same approach to trading. And I will tell about my approach. But here I've listed just a few data that you may use in your design of a trading model. Of course, the price, because in the end, you can look at or you can think of a lot of data, but what you trade is price, nothing else. And personally, I only look at prices. I'm not looking at any other things. I know that's a limitation, but in the end, my view or my gut feel is that prices should reflect all the info that exists around. Of course, you know that the info are not necessarily absorbed as soon as they come up in the market, but price should reflect all of this. So that's why I don't care about looking at news or looking at any other things. I prefer to look at prices. which are the most important things that you have to look at. Because in the end, that's the only thing you're trading. So you have also derived, I would say, financial data that you can have from the prices, such as oscillators or this kind of stuff, that can be interesting, especially at turning points. But I know that some people are using this to design trading models. But this is the price to a certain extent. So that's a transformation of the price. So it can make some sense. Some people are trying to use economic indicator to design trading strategies. Good luck for them. But especially, I would say, traditional asset management companies, because they have, let's say, low-tech investors, and because they need to have a speech, and because they need to be able to explain their decision, usually rely at least on paper on this economic indicator to take decisions. For me, the economic indicator is like driving, looking at the mirror. I mean, you're going this way and you're looking at what's behind you, which is fine. I mean, on some occasion, maybe for trend following model or long-term trend following models, it could work. But what is sure is that at the turning point, you will see nothing. Because usually when the markets start to basically to turn down, the economic indicator are very, very, very nice. So there's no way you should sell, basically. Sentiment data, I think it's, we've touched upon this one, and I think it's an interesting thing to look at least that's something that is developing. You have a lot of engines that are trying to capture this sentiment. And even before that, you had a lot of surveys for the traders and for the asset managers by the big banks that you can find on Bloomberg, for example. So this is always something that people have tried to understand and measure in order to look at what the market are doing and to find some sense into the price actions. So this is something that maybe you should look at. And of course, for this one now, you have so many data that it's not an easy job to analyze them, but at least you have a lot of info. One very example is that you do a Google search on a particular subject at a particular time. So for example, if we go back when we had this oil, I would say, run up, I think it was 10 years ago or something, and then the big crash. And I'm pretty sure that you could correlate to a certain extent what was happening on Google search and what was happening in the oil price. I'm pretty sure you can do the same with Bitcoin these days, especially since the crash that happens since the beginning of the year. So it's interesting. I'm not completely sure that's an indication of what will happen, but at least that's an indication of something that is moving. So it can be an interesting information. How do you analyze that? That's a very, very tough job. First, you need to have reliable sources. So that's the first thing. Second, you need to analyze on a very, very large scale. So you need to have the right tools. And then you need to have some tools that will help you basically put what you have found into categories. Anger, euphoria, whatever you may think of. And then decide, depending on the category you fall into, what you should do on your trading systems. But that's something that is quite complicated. There's a young French startup that we are trying to partner with that is doing just that, analyzing the mood of the market. So they've launched an indicator which is called l'humeur des marchés, so the mood of the market in English. And basically that's their job. They are analyzing on a large-scale basis. They have a lot of data resources, and they have data scientists that are doing just that, and they have to make them their AI engine learn. So there is a lot of, let's say, manual learning, because when you talk about AI, at the beginning, you have to learn to your engine what's this or what's that. And then once they're autonomous enough, then they can do the work on their own. Yes?
At that point, do you think it's a leading or lagging indicator?
To be honest, I don't think it's that lagging. I'm not sure it's a leading indicator. So I think it's about on-time indicator. But once again, when you talk a lot, let's say that you have a company that for whatever reason, you have a big peak in the in terms of, let's say, a Google search. Is it because it has been taken over? Is it because it has gone bankrupt? So you know that there's something going on. Whether that's something good or bad, it's difficult to say. Just to give you a little bit of I would say, background, let's say if you rely on Google search to do some trading, of course, nobody would do that, but if you would do that, you have to be careful about that. And cross-market data, this is interesting. So we're still talking about market data, so I think it's interesting. And I've developed some models that are based on cross-market data. So for example, we all know that the VIX and the S&P 500, to a certain extent, at least on a short-term basis, are correlated. And that's quite normal. So in some cases, you might go for an indication of trade in one market and do the trade in another market. So, for example, VIX and S&P 500, that's an obvious choice, and I've developed some models on that. Another one that is easier maybe to understand for forex traders, imagine that you want to play the Euro-USD exchange rate. You might want to look at the Euro interest rates and the US interest rates and see whether, because in the end, normally, FX should depend, everything being equal, on only differential of interest rates. So you might find some interesting signals using the interest rate to play the forex pair. So using cross-market on some occasion can be interesting, but you need to make sure that you're not using, I don't know, the oil price in order to trade, I don't know, the wheat on the commodities market, because as far as I'm aware of, these two markets does not really look correlated in any sense. Even though on the price action basis, on the short-term basis, maybe they are correlated, but it's not something that should be the case. But I think that's an interesting one when you're developing a model. Looking at other markets to get your signals can be interesting.
Just a quick question about correlation, if I may.
Yes.
Like I have this issue when I develop algos and with forex, and obviously there's huge correlation in forex. How do I basically tell the algo which pair to take over another? Because at the same time I can have multiple signals at the same time from multiple pairs. So basically my question is, how do you avoid having too many signals at the same time?
I don't have any answer to that, to be frank. I know that trading on correlation is a tough job because correlation are not stable. It's the same thing I was saying before. It changes a lot. So whether this correlation do make some sense or not, usually that's the case. And sometimes you don't know why, but correlation stops to happen. And you know that there is some kind of disruption in the market going on. Usually it's not for nothing that the correlation is not working anymore. But to be honest, I have no answer to that, to know when to take into account or not take into account your correlation. That's not something I've really developed in terms of approach using correlation, because most of the correlation I'm using, especially on the S&P and the VIX, they're quite stable. In fact, this correlation. It can happen sometimes that it's not working, but it's on a very, very short-term basis only. So for me, what are the main characteristics for designing a training model? First thing is that your input is data. You have a systematic approach. That means that you need data to go into your system. Most of the data that I use, and because I'm using only prices, are fairly clean data. And it's very easy to download data from any data provider. It's free if you go on Yahoo Finance. As I'm having a very low frequency approach, I can have all the information I need to. It costs me nothing. If you were to, let's say, I don't know, analyze Twitter data, or to analyze, I don't know, newspaper data, how do you get them? How do you clean them? That's a very, very tough job. That's something that is very time consuming. In any project of this kind, what we say usually is that 80% of the work is on data quality. So you spend a lot of time on data. For example, let's say that you want to design a data on credit. We all know that, I would say, credit, I would say measure or credit levels, they have not been specifically stable over time. Nowadays, you have a lot of data on credits. 20 years ago, for example, on high yield, it was quite difficult to get some data on high yield. If you want to do a backtest over this kind of period, how do you reconcile over time the various indices that have been existing on credit? So you may have to do a lot of work depending on what you're using regarding data quality. And basically, as we say, garbage in, garbage out. So if you put something that is not working on the input, whatever you find will not work or should not work. What I usually do once I've done this part is I get what I call raw trading signals, i.e. a series of -1, 0, +1. So basically, you short, you do nothing, or you're long. And it basically should give me something that is more or less going up with this or with reasonable level of drawdowns, at least not too many peaks. And basically, when I do select something, at least I need to have something without working a lot that shows me something like that. And then starting from there, you can try to not optimize, but at least really enhance a lot these initial trading models. And then after that, basically that's a systematic approach I have, and it's quite mechanical, I should say. The most important thing is to get these raw trading signals, because this is really where you have some intelligence at the beginning. And this is really something where you get something uncorrelated to what you're going to do with the various strategies. Second thing I do once I've done that is I'm putting some filters, i.e. I want to trade less and still earn the same level of money. Why? Because when I have trading signals that on average yields me nothing, I should not trade. So if I can find some filters that allows me to reduce my trading from these raw trading signals, then I'm happy because I'm in the market less of the time. That means I'm taking less risk. And if I don't really change the end result, I'm better off. All other elements that could be interesting, so trading less, yes. Reducing drawdowns, because drawdowns is basically when you are at the point of suffering, and nobody wants to suffer when it trades. So if you can have some filters that allows you to avoid over trading, it's always interesting. So when you have found something, usually you should ask yourself whether you should follow your trading signals all the time, or whether you could avoid following them some of the time. And in these cases, it has to not affect too much the profitability, because in the end, that's about profitability. But it should reduce your max drawdown and reduce your volatility, because in the end, you're not there to trade volatility, or you're not there to have a volatile strategy, or you're not there to have a high drawdown. Once you've done that, you can add a last element, which is money management, and people usually forget about money management. Money management is, remember, my raw trading signals tells me when to be in, long, short, or neutral. When I'm long, how much should I buy? This is a very interesting question. If you're a poker player, usually the true professional poker player, they are not. It's not only about, let's say, taking big bets It's about taking the right bets and betting the right amount of money. And in the end, why are they earning money? Because they know the statistics of their hand, and they know what's the odds of winning or not winning. And depending on the odds of winning or not winning, you should know how much you should bet. And this is a really important part. And if you go in the trading desk in most of the banks, that's something that is really important, money management. So money management, you can think of, let's say, as a risk approach. So once you know when to trade, what's the direction of the trade to take, you should also ask yourself, how much should you bet on this particular trade? Very simple examples for you to try to understand. The risk parity funds, what are they doing? They're trying to take bets and basically even the risk that they're taking. So basically what they do is they take a position and more or less they divide by the volatility. Give or take, that's their approach. So basically the more volatile the market, the lower their position is. In order to have something which on a risk basis, given how they measure risk using volatility, they have something that is more or less constant. So you can think of money management as a system like this. You can think of money management that may be a little bit more complicated, but at least you should ask yourself, how much should you bet when you have a trade to make? And this is really interesting because if you have a good money management in place, if you look at the distribution of drawdowns, usually when you do something without doing this exercise, you have, let's say, large drawdowns and smaller drawdowns. And usually if you have a good money management system, most of the time, you ended up having a lot of, I would say, several drawdowns of similar, I would say, magnitude, which is much more interesting from a risk-return point of view if you're an investor. Because at that point of time, you have a good knowledge of when to, I would say, cut your exposure or when to put more exposure to your trading system. And also, I would say when you're in this business is about having regular return, regular steady return, with a measure of risk, which to me is not volatility, but it's the measure of drawdown, which is rather, I would say, predictable to a certain extent, or at least the lowest value is rather predictable. And usually a good money management system will allow you to have such a profile in terms of risk reward. How to judge in the end what you've done, whether your system is working or not. As I was saying, the stability of return, I don't want to have, once again, I'm not in the business of, let's say, takeover, where you're trying to find the next target that is going to be buyout by a company at a 30 or 40% premium. I'm here to make steady and predictable returns. So I think it's important when you judge or when you look at your strategy to have something that goes up quite steadily. For me, that's a very good indicator. Of course, if you have some acceleration on the upside, it doesn't hurt, but at least you should have something that goes up fairly regularly. Risk reward measure, so sharp, but for me, what is better is return over the drawdown, because in the end, the expected return is what you should earn, and the max drawdown is what is your, let's say, least favorable situation. I think it's important to have something that yields you at least one time this, but depending on, yes?
So you emphasize drawdown many times in the chat. The issue with drawdowns is by definition tail event, so you don't see a lot happening in your data or SAM, and it measures with a lot of noises. So when you see a simulation that says drawdown X%, how do you actually think about your drawdown going forward? Do you just
to me, my drawdown is once again my max risk I'm willing to take. That doesn't mean that because I have seen over the last 20 years drawdowns of max 10%, that in the future it might not be higher than that. I think nobody can predict the future. But at least if it has happened several times, especially if you're on the equity market and you've gone through 2000, 2003, 2008, and so on and so forth, you know that you have lived through different cycles. That gives you a good indication of what you could happen in the future, even though it might not repeat, but at least you have some good indication. If over this long period you have found, I would say, regularly drawdowns of, let's say, 10%, but no more than 10%, that gives you a feel for the type of risk you're taking. But that's just a feel. And then over this max risk that I'm taking, how much am I willing to gain in order to be able to bet? If for me, getting 1 times this max risk is enough to bet, and I found something that I would say achieved this goal, then fair enough, I can bet. If I'm someone who is, I would say, more prudent in my approach, and I want to earn 2 times this level, then I know what's the target. But at least you get a feel for how much you can expect to gain on a yearly basis compared to your max risk that you have observed historically.
So will you cut your position when it touches your max risk? Or?
That's a good question. If you do that, and you do believe in your system, and your system is good, you will, if you come back to the first, or one of the first slides, why quantitative finance, you would cut exactly at the wrong time. Should you bet twice the amount at that point of time when you have suffered a 10% loss? Maybe not. So it's for everyone to decide, and what do you do when you are at this point? I personally would not cut nor would not add more at that point of time unless I have a very diversified approach. So if, for example, if it happens on one model and I'm trading 10 models, I might increase slightly the part of this model in my overall allocation. But this is within an allocation. But what is interesting at this point of time is to observe what's happening with your model. Does it come back or not? If it does come back, it gives you more confidence to trade it in the future. And if it has come back, let's say, by 50% of your drawdown, maybe at some point you could say, well, I'm confident enough that it has worked, and it will reach the drawdown at 0. So maybe I will increase at this point of time because I'm less in a stress. I still believe in it because he has managed not to go lower than what he should have been. And I might go a little bit above my allocation to this model at this point of time. That's a prudent approach. I would not necessarily trade on the bottom, but on the way up, and I've done it quite recently myself. On the way up, basically, I started to increase slightly my positions. Max drawdown, so the absolute level of max drawdown, that's basically that's how much you're ready to lose. So in any game, especially a poker game, how much when do you need to leave the table? Is it at 0? Is it at -50? You need to ask this question. That's a very fundamental question. How much are you willing to bet? And usually what I do is I have a separate account, and basically anything that's on this account, I'm willing to lose it. But at least it's segregated from the rest. And the rule is that you should not add anything to this account. What you can do is withdraw some amount from this account because you have done well enough. But you should never increase this risk, and you should never put anything more on this account. And the last point is, as I was mentioning, is the complementary with the other strategies that you may have found. Once again, one strategy might work over time, but you will have difficult period, and that's normal. If you don't, I would say, put some money at risk, you don't deserve a return. I.e., you cannot find a martingale where you are sure to win every day. And the big guys, if you look at what they are doing in the investment bank, they don't rely on a single or a particular model or a particular trading desk. What they do rely on is a series or a bunch of them. And they all have more or less the same risk-reward profile. But then because they are not correlated, in the end, they ended up having very, very nice return. I think there was one company, I don't remember the name, a US one, that went public a few years ago. And basically, in a single year, they almost had never a down day. Not because they were extraordinary, it's just because they were that much diversified with a regular earning desk, and that's it. So in the end, I think it is a game of statistics. The more play you do, the more chance you have to earn money in the end, provided, of course, that you are trading uncorrelated strategies. That's the starting point. But that's a very interesting point, because here really you can touch upon what diversification is all about. And that's it. I think I'm going to start a new one. I don't know how's the format exactly. I've not been briefed on this one. The next one is on cryptos.